There is a very strong push and pull game between founders and investors.
That's not all what investor is seeking for.
There's a $3 trillion total available market in Play&Earn. And if we capture only 0.1% of that, we can have this much revenue.
Fully diluted market cap, initial market cap.
There seem to be token economies being created out of thin air.
It has nothing to do with mass adoption, and it has nothing to do with real attraction.
You know, we've had to fail first to recognize those lessons.
It's just unbelievable. So this is in my channel. After quite a long break due to summer vacations, we come back with super relevant content for startup founders and tech entrepreneurs. And today we have amazing guest. We have Sasha Asheghi, who is co-founder and managing partner at Arcanum Ventures, crypto VC investor, crypto enthusiast, very, very knowledgeable about tokenomics, about investment decision making, and actually a great guy whom I really was fascinated about when he joined our pitching sessions and asked super smart questions to startup founders. Hi, Sasha.
Hello. Thank you so much for that introduction, Nelly. That was very flattering.
Can you please give a brief intro on Arcanum Ventures and you as a VC investor in crypto? What is your focus, investment thesis, and so on?
Well, first of all, thank you for having me on here. I really want to show my appreciation because I think since that last pitching session, you've started to show great interest in us, and I feel like this collaboration is very strong and there's a really good energy to it. So thank you so much. So at Arcanum Ventures, I have co-founded Arcanum Ventures with my partner, Carmelo Giuliano. And we started in the space really almost 2 years ago in a very similar function for a venture capital studio. We had helped a number of projects come to market, design their go-to-market strategy, their token economy, marketing strategy, business development strategy, etc. And it really positioned us in this unique place where we learned the ins and outs of the cryptocurrency startup space. We decided to start our own shop, really, and focus on what we love, which was helping promising and very, very enthusiastic teams bring their projects and their products to market. And here at Arcanum, we not only focus on venture capital, but we also incubate a number of projects. We advise a number of projects. We work with different VCs, different organizations in the cryptocurrency space in a wide variety of ways. And we also are focused on building a few different product verticals that align with business development and marketing services to try and diversify ourselves in this space. So really our goal is to find projects to help bring to market, but also serve as a sort of digital asset authority and educator in the space. One huge gap that we saw in cryptocurrency over the past year was the extreme lack of valuable and good informative education. And we saw there was a lot of misinformation being traded around. So we want to try and address this and help other investors that are maybe incoming into the space from traditional finance or new altogether, and help them understand the pitfalls, how to avoid them, what to look for, and how to gauge a good investment. So our investment ethos is quite diverse. We don't really have a specific area that we focus on outside of the fact that we really like to back teams that show promise, they're dedicated to their vision, and they're dedicated to the vision of incorporating blockchain and Web3 technology in moving the space forward. There are so many startups that are really missing the point when it comes to the real benefits of blockchain and decentralization. There seems to be a lot of startups that are coming to market that seem redundant, or maybe they're not addressing a real gap. So this is what we look for first and foremost. And we're very much a small VC. We're very much a small advisory firm. We're very selective about who we work with. So we're afforded that luxury. And it works best in our favor because we're a small team as well.
And you also mentioned that you're looking to invest in enthusiastic teams with great passion, burning eyes, and some breakthrough ideas. But these I hear nearly from every second or every first investor in this space. At the same time, I see that sometimes, especially on this bear market, when the number of deals fell dramatically, that a lot of great teams with great background, burning eyes, passionate, and even great MVP, already proven and working, they can't really secure funding. Okay, one thing is the current bear market, but another thing that it means that's not all what investor is seeking for. So what is this secret parameter you're looking for when you decide to invest?
Well, it's actually a really interesting point you brought up. So I think a great value add that Arcanum Ventures brings is that we are not only an investment firm. Like I mentioned before, we have a lot of experience in seeing the pitfalls of the space, understanding where the traps are, understanding the step or the direction not to move in. And a lot of the investments, if not all of the investments that we make, don't just come with capital. There's been a really interesting conversation unfolding in the crypto space over the past couple of years where people are able to secure the funding that they need. There was a lot of hype and speculation in the market, a lot of great projects coming to market, and a lot of money being thrown at them. And they were able to be choosy with who they wanted to bring on board. And this is where you heard the term value add investor coming in. And unfortunately, a lot of VCs in the space, in my point of view, seem to advertise this and say, I will come into your network, I'll provide the capital you need, but I'll also help you develop partnerships. I'll help you connect with other clients. I'll help you along the way with business development. But a lot of them seem to fall short. And the conversation can go on for hours about the liquidation strategies of some of these VCs. But Carmelo and I are very invested not only financially in helping these projects come to market, but also from the other facets that can help give them the tools and the experience that they need to take that project forward. And in a way, it's greedy because we're protecting our own investment by helping these people along, by identifying, having natural conversations with them consistently and figuring out, all right, where's a stopgap? What's slowing you guys down? Where are the speed bumps and how can we help that? We're ensuring the accrual of the value in our equity in that company. So I think that is a unique value that we bring to the number of investments that we have. But outside of that, I think you're right in saying in the bear market, a lot of this slowed down. There was a slow in pace. There's a slow in interest in investing. We distinctly look for projects that are not thinking in the short term when they're coming to market. This is sort of like a strange plague that we saw with cryptocurrency projects launching, and then there was a lot of conversation for very, very hype projects on all sorts of social media channels about the token price, speculation about token price appreciating or going down. And Carmelo and I come from a more traditional investment background in securities and derivatives, where we understand a little bit more about fundamentals that can drive a business forward. So we understand that any sort of speculative price action talk is purely based on that, on speculation. There's no fundamentals. And a lot of investors in this space, they're definitely wisening up now, but they look at an investment from that one metric. How speculatively high can this go? And that is an absurd way of investing in a project or a team that's building a product that may have a 3-year roadmap. That they may be developing a product that does have real revenue generation that can come into that ecosystem and actually drive the value of that asset forward. Otherwise, we're just talking about marketing that is fueling that token movement. And I think this is a really strange way that VCs have been talking about investments, because they're essentially talking about taking an early exit, taking gains out of their investment before anything's actually been done. Because launching a token, an on-chain token, a TG event, is not the end goal. That's the first step in a startup, really. You're just creating the asset that you've sold to investors, and then you have to actually create your product and figure out how to incorporate that asset. So on our horizon, we look at projects and teams that are focusing 3, 5+ years down the line. And what's their revenue going to look like? And how can the ecosystem develop? And I think that really, differentiates ourselves from some other VCs in this space that have proven time and time again that they're looking for an early exit because they need to reinvest that capital. And maybe they're not so interested in the success of your company long term.
I guess it's the first time I hear from crypto VC the 3-5 years horizon for investments. Usually it can be like from as small as 1-2 months to maximum 1 year. And I think that's what attracted a lot of investors in this space, this liquidity, this super fast liquidity of assets that you can get rid of and then reinvest them, as you said. With 3-5 years horizon, would it be sustainable from your profit point of view?
Another interesting question. So for, let's say, a VC that's simply investing and reinvesting gains, there is a sustainability issue there. But the bigger issue is that a lot of these VCs have a misaligned message. When they tell you that they want to invest in your product, when they want to see you develop into something big, but their gains horizon is much shorter, they're not being honest or truthful. And this isn't something that's novel in startup at all. I think even an 8 to 10 year horizon is very common in traditional tech. And we're not talking about something that's niche or different in crypto startups. We're talking about the same tech startup, but now we just happen to be incorporating blockchain technology. So really the time span for a team to develop a product and then watch the momentum grow as business development continues, that doesn't change. I think 5 to 10 years is reasonable. And that's and that's giving the project a show of faith that you believe in them long term, that you believe they're going to build something true and strong and good, taking the space forward, because that's what a lot of projects coming to market are advertising. Now for us.
And before we move forward, there is one thing I want to ask you about. I see hundreds and thousands of people watching our videos on YouTube, but I barely see any feedback from you. While I'm very, very curious to understand what kind of content you find the most useful and what you would like us to talk about on the next videos. So please take 1 minute of your time and leave a comment under this video about what questions should I ask the next time, what topics should we raise, and what speakers should we invite. And of course, I will appreciate if you put like under this video if you really think it is valuable for you. Thank you. And if we speak about this mid to long horizon, is there real sense to invest in tokens versus equity then? Correct me if I'm wrong, but also with tokens, there is the risk that if token does not fly within the first, let's say, half a year after TGE, then the chances that it recovers and goes up less and less and less.
Well, that's a great question, and it's really a case-by-case basis. There are some startups that we work with that make sense to launch both a token fundraise because they need to generate the capital quickly in order to start building. A token event or token generation event and a token sale has definitely time and time again proven to be the easier fundraising route in the tech startup space right now. And that's also the same for the same reason why project founders are not going through traditional tech, because maybe they're forced to have more conservative valuations, and they have to deal with real sharks that are seasoned in the space, that are looking to take much larger chunks of equity, or much larger chunks of equity for the capital they want to put in. So it really depends on the situation, because some of these startups, it makes sense for them from a business development, an ecosystem point of view, and a long-term horizon point of view, that they would be seeking a merger or acquisition down the line. And in that case, an equity sale or an equity fundraise from our side would make total sense. In a lot of times, what we talk about at Arcanum that concerns us is investing in a token where a project may be seeking a merger or acquisition down the line, where the token and the investors of the token can be deprioritized, or that ecosystem can be removed altogether if the incorporation of that token into the ecosystem is not fully fundamental, if that product can survive without the crypto, for example. So we really take it on a case-by-case basis. But this is also why we're incredibly selective, and why we're incredibly scrutinative, and why we also speak with teams time and time and time again and try and ask every question we can think of before we invest. We don't invest in a lot of projects, especially in a down market. We're very, very careful about what we invest in, and we make sure to try and cover all angles. And for us, it's not a numbers game. It's all quality. Arcanum Ventures, the VC arm itself, we are, because we're small, we're afforded the luxury of not prioritizing fast gains to please shareholders, for example. We are just prioritizing our ethos. We're prioritizing what's important to us, which is helping back the projects and taking the space forward. So we don't feel a need to rush and try and take a gain and then reinvest it before maybe tokens or IDOs are relevant in 3 years or who knows what happens. But we feel like we're in a comfortable spot and we really trust our fundamental process, which makes us feel like a little more at ease.
It sounds very appealing and familiar for me. We also started investing ourselves last year, small ticket size via small angel network. And I sincerely cannot understand how some VCs make decision after the first call with the founders. I mean, it's just unbelievable because you need at least to have numerous calls to understand and also observe some traction in the progress. Yeah, how they react, how they answer, meet the core team, and so on and so forth. So I believe that we very, very much aligned here.
Don't pat me on the back so quick because, a lot of the things that we put in practice now are through lessons learned where, we've had to fail first to recognize those lessons. And, it's a stupid analogy, but I think it's very relevant. If you were to make any sort of life decision that involves some sort of financial aspect, like some of these ticket sizes that some of the VCs throw around, that's a car, that's a house, that's something big. And I don't think any average person would make that investment or make that purchase just on an hour phone call. I think it takes a lot of research to understand what you're buying. And our ethos, our mentality is the more we try and plan this out, then the less likelihood of failure. And you can't plan for everything, but you can hope for the best.
True. And you also mentioned a few times about budgeting and proper financial planning. That is also what attracted my attention, since I lack even these words and terms in the VC world. I mean, that many years in mind was vertical agnostic, and we worked with non-crypto startups as well, where the business model, monetization model, revenue, it really plays the huge role. But here, during the last year in crypto VC and startup scene, I heard the word budget maybe a couple of times, and not from VCs, from startup founders who wanted to understand how to budget, for example, or make financial planning for the new protocol or new gamify project. How do you see it? I also saw you wrote about budgeting in one of your Medium articles about tokenomics, as one of the core aspects when you analyze a token economy of the startup. How do you look at the budget of the crypto startup?
Well, this really comes down to a mixture of operations understanding and intuition. If we're approached by a project to invest, then we really want to know all the angles. And what we're looking for as one of our fundamentals is fiscal responsibility, financial responsibility, understanding what these funds are being used for. And from our point of view and our perspective, does that make sense? So if we're approached by a project for investing, they send us their investor documents, we have a conversation. If they don't have a budget, we don't even look at that, because we need to be reassured that these people are thinking about what they're going to build and how they're going to build it and trying to anticipate where the speed bumps are. Now, we've had great fortune in having some exposure to the development side of things, and in a tech startup space, that's essential, right? Because we have an understanding of maybe how much it takes to build out a DEX, how many devs you need to build out a game, and how many artists. What is the man hours or labor involved? So we can kind of give we ourselves can, we have an idea of what is the operational or development cost, and then does this align with what they want to fundraise and what they claim to be their runway. Now, we also look very closely at revenue projection figures and business development figures, and we try and be very conservative when we see this. A lot of times you see a slide in a pitch deck, and Nelly, you know this very well. You see, for example, on Play-to-Earn, there's a $3 trillion total available market in Play-to-Earn, and if we capture only 0.1% of that, we can have this much revenue. That's a very, very thinly veiled metric. And I don't think anyone is really predicting that they'll be capturing even 0.1% of a total market that's been in development since 1980. So it really comes down to being what's realistic, and it also comes down to a bit of psychology, because there is a very, very strong push and pull game between founders and investors and what's being communicated. For example, if a project sends us their pitch deck and they communicate to us, total available market, we understand that these numbers are flashy, and maybe to a casual investor or a numbers game investor, they take one look at that and say, this could be good. I'm interested. I have some cash to throw around. But we don't do that because we don't want to back the wrong teams, not only for the fact that it's a bad investment, but also we don't want to tie our names to something that is maybe rooted in speculation, or they don't feel like they can deliver, or we don't feel like they can deliver. So it's really a big mix of everything. And to be perfectly honest, we've been trying to unpackage our fundamental analysis process for quite a while now. We've got a 20-page sort of checklist report that we run through on investor opportunities that we feel are strong as a form of a deep dive analysis. And we actually create internal reports. We're thinking about maybe making these reports public just so people can see what our process looks like. But it's a very big mix of intuition and strong process. So it's different every time.
I think if you decided to open these reports for public, it would be just priceless knowledge base and content for everyone here. Even in traditional VC sector, only few top tier VC firms, they publish their investment reports or venture analysis reports on the portfolio companies. In crypto space, I did not see even something similar to that. Moreover, sometimes I scroll Reddit, I see a lot of posts like, oh, I was invited as a venture analyst to the crypto VC firm. Can you send me the samples of the due diligence report, because I have no clue how it should look like or whatever else?
No, we would love to publish this content, honestly. There's a lot in there that we take from our own experience in the space, which I don't want to say is all good. So there's a lot of still very, very controversial happenings in crypto. And these are some of the things that we look forward to as, let's say, negative markers in evaluating investment. And, our goal is to help educate people in the space about these shady happenings, or maybe just mismanagement practices. But in doing so, we kind of want to release content to explain why it's significant and what it is and what's happened historically before we do that. Otherwise, it might just look a little strange. So we're definitely thinking about making some of this public. We're definitely putting together a content strategy to highlight some of these aspects of the space. But I completely agree. This is coming from a more traditional investment background. When we started putting together some of these reports, we were modeling them after, for example, a Morningstar report that you see on Apple that's being released every quarter. You think, okay, this is a deep dive analysis in the fundamentals. That doesn't exist in crypto. If I think when I first got into space and I searched on YouTube crypto fundamentals, all I saw were charts. And that's literally not the definition of fundamentals. So we saw this gap. We said, hey, there's a real need for this. And so we've been putting in the groundwork to try and develop this out a little bit more. And we were very fortunate to be working with an amazing organization right now and helping along their business development and fundamental analysis process, that we create their own sort of personalized report for them. But we're thinking about maybe expanding that and looking at some popular projects in the space and helping other people understand how to evaluate an investment here, because it's very different than a stock, for example.
Sorry if I understood you correctly. So you work with some organization that helps you to build these due diligence reports.
It's kind of been a dream of mine for a while. We are being commissioned to some extent by a number of organizations to sit around and think. which is wonderful, right? They ask us our opinion on specific investment opportunities, and we give them an honest truth and say, this is what we think about this. This looks pretty good. And in some cases, it really turns out that, wow, you know what? This team looks very well rounded. The economy is very well structured. I'm seeing a lot of innovation. Can you also connect us with them to invest? So it's a really, really cool situation that seems to be unfolding over the past couple of months, actually.
Awesome. And by the way, guys, if you are interested to get to know the latest news about Arcanum Ventures and the latest content, we will leave the links to the LinkedIn profile of the company and Sasha, of course, and Twitter. So check the description of this interview and follow them in social media. Sasha, coming back to the question about budgeting, and you also mentioned a few times revenue streams, revenue projections, etc. How do you approach this in crypto startup? Because in many crypto startups, when you ask them about revenue projections, they say, come on, the token will grow and that is how we will earn money. They don't consider traditional revenue streams the way that we build it in non-tokenized startup.
And this is a really interesting phenomenon that we've seen in the kind of infant stages of crypto in 2021. There seem to be token economies being created out of thin air. And there didn't seem to be any sort of clear revenue structure or revenue streams attached to any products being developed. And it's becoming much more commonplace now because investors, after a couple of down cycles, are starting to wisen up. They're understanding what they're buying now. But there's been this really strange phenomenon, and it really comes down to understanding who your target market is when you're developing a product or when you're starting up. There's a lot of different things that projects seem to be missing, and like I mentioned before, there seem to be a lot of projects that are in development that are, they utilize Web3 technology and they're creating something that seems cool, but maybe it's not addressing a real problem in the industry. And when it comes down to business viability, there's a number of factors that you need to consider, right? Is there an existing gap? And if there is a gap, is there a need to fill the gap? And if there is a need to fill a gap, then maybe you already have a target audience built in. But if, let's say, you're producing something that seems to be directly competing with another product on the market, then you need to consider what are your advantages. And it doesn't just mean product advantages. It means maybe business development advantages, networking advantages, etc. So it's really understanding who you are, what you're building, and what's already out there. If there's no one to buy your product, then no one's going to use it. And if no one knows about your product and you don't understand how to market it properly, then no one will use it. It's a really big holistic view. But business viability is something that comes down to not only marketing, potential target market, business development strategy, but it really comes down to operations as well. And this is something that Carmelo and I have a lot of experience with in understanding the logistical aspect of how a business can unfold. For example, if you were to create a software as a service platform and the success of your business depended on bringing in new clients, then how many new clients can you bring in? You talk about total available market, service available market, but no one really talks about, for example, how many business development people and account managers do I need to onboard? What's the onboarding duration? How long does it take for me to get to the first call, the second call, the contract signing, the finalization, the technology integration? And then is that scalable? How many more employees do I need to bring on to double that output or triple that output? And by trying to go down and plan these little minute steps, you really understand better how successful can this business be. And if you're talking about bringing in, let's say, 5,000 customers in the first year, then if you break it down to a daily action list or even a weekly action list of bringing people on board in your ecosystem, do you have the resources to do that? And if not, how do you acquire those resources? Do you have the funding? So we take a look at really all of this and try and understand, is what is being communicated to us in an investor document or a pitch deck, is that reasonable? And is it sensible? And if it's not, why not? Are we being misled purposely? Or is there maybe a miseducation? And so these are the kind of gaps we try and identify and see if there is a strong business viability with this particular opportunity. Is there any way for us to come in and help out if we believe in this team? And maybe they just need the right tools to do that. So from a business viability perspective, I think there's a lot of different factors to look at. But when it comes to investing and understanding business viability, it goes back to the same common principle. If you were to try and take a very, very deep look and plan out as much as you can, then you're going to have a greater understanding of if that is a good investment or not. And I think this is another gap that a lot of VCs miss. They don't spend enough time evaluating an opportunity because it's a lot of work. It takes a lot of time to sit there and have discussions and figure out what's going to happen on a day-to-day in this business of 15 people and 15 MacBooks. I hope that answered your question. I think I was just rambling at some point.
Well, it definitely answers my question, and I hope that it really is eye-opening for people who will be watching this video, because I can confess that I don't see that much startups here in this area that can answer these questions. I mean, that can tell you how many people they will onboard within the next 1 month, 2 months, half a year, what resources they need. And I'm not even talking about sales prospects and so on and so forth. I mean, the typical process is building some community in social media, and hoping that this community, they will buy our tokens on higher and higher and higher price, and then balancing this price with some market making activities, whatever else, and earning on this price. Nobody even is talking. Very, very rare I see startups who are talking about this as
There's a really, yeah, it's been a really interesting evolution that we've seen in the space. And I hate to say it, but we've seen many I don't use this word lightly, bad actors in the space that have created these token economies. And people get excited in the space when they try and learn more about cryptocurrency. They try and understand what is crypto, what should I buy. This is a question I get from friends and family all the time. What should I buy? And this is a question I refuse to answer, right? But people. I think a lot of people have entered the space maybe for the wrong reason. They enter the space because they're blinded by the potential gains that many people have been plastering across their YouTube channels or Twitter or whatever. And of course, it's attractive. Of course, everyone wants to make money. But that fueled so much interest towards these token economies that were built on almost nothing. And by almost nothing, I mean, if you don't have any revenue, if you have no real product value, then you have nothing to funnel back to your supporters, which are your token holders, right? You are crowdsourcing funding through a token launch, and it's your fiscal responsibility to try and bring value back to those supporters. And there's been very little clarity in a lot of startups in this space over the past year on how they want to do that. And Nelly, you mentioned yourself, everyone just says, oh, the token price will go up because people will buy and buy and buy. One of the greatest innovations in this space that I've seen is the automated market maker. And it's such a perfect piece of technology. And I love it so much because it's predictable. It's created a microeconomy of an open market system. And that dictates the price will go up if somebody buys. And then the price will go down if somebody sells. And if we're talking about a closed loop system token economy with no incoming value or revenue, that means for every winner, there's a loser. And so many people have failed to understand this. And if projects have come to market like they have in the past year saying, oh, the value's going to increase because of demand, everyone's going to love it, it's going to increase, either they're ignorant or they are trying to mislead people because they want to liquidate their own supply and cash out. And we've seen that so many times. And it's been such a downfall of this industry. And it really gives it a bad name because there's so much good here, not only from a technology and Web3 and blockchain perspective, but the actual cryptocurrency component, decentralized transactions, decentralized buying and selling, decentralized community-driven initiatives, all of this. It's so amazing what can unfold in this space, but there's definitely been a lot of greed, I think, that has really turned it in maybe not the right direction temporarily.
Speaking about greed, in the perspective of token economy or tokenomics analysis, you told yourself that a lot of traditional VC investors, they do not know how to enter this sector. They need to be educated. So I hope that some of them will learn from your advice. Where to start from when you look at a very interesting startup from DeFi or gamify sector, and you see their tokenomics, standard numbers, fully diluted market cap, initial market cap, token supply, whatever else, how to understand these numbers and what to look at. Because I see a lot of investors who really look at only these metrics. They look at initial market cap and then they say, oh, this startup has too big or too small or whatever else, or fully diluted market cap. And they do not even attach these to the business specifics of this or that startup.
There's a lot of psychology in a token sale model, and that is largely dictated by investor interest and market conditions. So let me give you an example. In early 2021, a lot of projects were launching with extremely high fully diluted market caps. There was a lot of speculation, and token prices appreciated very fast because of a lot of money coming into the space from, let's say, novice investors or people entering the space that really want to try and capitalize on that upward hype. So you talk about, for example, a company that has 7 dudes and 10 MacBooks and a handful of office chairs worth $250 million, and they haven't made anything. Fully diluted market cap is a great metric to say that's an awful investment. I'm not going to buy into that. I mean, if you're looking at one metric, but there's a lot more that goes into it. And you're absolutely right when you say it's not just looking at one metric or fully diluted market cap and trying to understand if this is good. You need the whole picture, really. You're looking at maybe one pixel. So if fully diluted market cap is extremely inflated, does it make sense with what the company is trying to do in, let's say, a 5-year timeline? And does that match the revenue projections? And there's a lot of lessons that I've seen a failure to transition from traditional finance into the Web3 space. And so there's very, very tangible rules of thumb to say, okay, if you have a token sale model, which is essentially like an IPO, and they are selling a portion of their tokens and they're valuing themselves at this much. Does that make sense in the whole picture of it? And so you had projects coming to market that had, let's say a total token sale of anywhere from 5% to 30%. That says, for example, if you were to sell 1 token, then you retain 19 tokens. That's an extremely inflated valuation, even given like very, very good revenue projections. 30%. That's very, very undervalued in my point of view. If you were to start a company and sell, 30% of your company right off the bat to investors, then that's a very large portion to sell. So there are definitely some metrics that people can look at to try and understand from a token supply perspective. But there's a lot of very, very small things that come with exposure and intuition and market conditions. I wrote an article, I think, 1 month ago talking about liquidity pools or liquidity provisioning in a token sale model. And the article was about an evolution and how this tranche had grown in size. You see, for example, a pie chart, and you see the liquidity tranche is maybe 3% of the tokens being dedicated to that. And then all of a sudden, you start having all of these projects claiming and actually doing, liquidity provisioning through crowdsourcing, offering staking rewards for their users to come in and stake tokens on both ends of the liquidity pool to try and crowdsource that function. So you're essentially crowdsourcing an incredibly essential function of your business, but at the same time, the liquidity tranche on average increased from 3 to 4% to 7 to 8% and nearly doubled throughout that time. So you look at this and you think, if that's being crowdsourced, then why are they retaining more tokens? And maybe there's something else there. Maybe they're trying to offset or they're trying to retain more supply, or there's greed involved. So there's a lot of these little nuances that you have to try and understand how they're evolving with market conditions. And a lot of it, I had a tokenomics mentor when I first got into the space, and I sort of had this like come to Jesus moment where I woke up in a night sweat, like, is it all just window dressing? And he told me yeah, a lot of it is window dressing. You see a lot of companies, they have a 30% tranche for ecosystem, and that's all the information you get. You don't know what those tokens are being used for. So it's hard to evaluate really, but you really get that picture from maybe speaking to the project, understanding what their plans are, understanding what they're trying to communicate, because you can't communicate everything on a white paper. So you use that little bit of intuition, that curiosity, try and tie in with the big picture and ask, does this make sense? But my advice to a lot of people that reach out to me to learn more about tokenomics, there's only been one consistent piece of advice I can give, which is read white papers. So many people do not read white papers, and they really underestimate that. A white paper is the groundwork of a business. By reading a white paper, you should understand everything about how that business will function. And if you understand how 100 businesses function, then maybe there's 5 good businesses in there you can pick out and say, I like that. I'm going to look for more of that.
So white paper here is an analog of business plan in the traditional sector, right?
Absolutely. And it's kind of sat in that spot for the past couple of years, I think. And traditionally a white paper is just an explanatory document helping people understand maybe the technicals of a product or something. But here, a white paper is an analog for a business plan. Whereas in a traditional business, you might have a 50 to 100-page white paper. This is another metric that we look for. If we have a company seeking funding and they have a 16-page white paper and half of it is pictures, that doesn't tell me a whole lot about your business. So, this is what this document should ultimately serve for, helping people understand, investors understand what they're buying and what is the value of that going to do depending on how they progress down their business development or roadmap.
Do you also observe right now that the valuation of majority of startups are falling down? And how do you think, will it be consistent trend, or it will change immediately after market recovers, after the downtimes?
That's a great question. We talk about this a lot, and I honestly don't know what to think. Part of me, the very hopeful part of me is I hope to see investors that have become smarter through being burned. There are a lot of investors in this place that lost a lot of money, and they lost money for a wide variety of reasons. But I suspect one of the biggest reasons was hasty investments and not fully understanding or asking the right questions. And hopefully, people take some lessons learned from this. They understand a little bit more about what they're buying, and they're a little bit more cautious about what they buy before they actually buy it. So I'm really hoping the majority of people incorporate these lessons moving forward, and they're a little bit more scrutinous, because with every bull market, unfortunately, there's a new influx of projects that are jumping on a moving train that are trying to capitalize, fueled by, let's say, social media influencers that are trying to widen the gateway to bring in more users, more people into this ecosystem. And they're doing that through flashing very, very basic metrics on very, very essential human needs, like surviving, like having enough money. And they're pulling at people's heartstrings, and they're getting people interested. And so this new influx of people that maybe don't have all the right tools or exposure to make a solid investment, that's more exit liquidity, unfortunately, for a lot of people in this space. So with every bull market, I think we're going to see maybe a greater disparity of a demographic, more more veteran investors that know what they're buying, and then more novice investors that are still trying to understand the space. And we recognize that gap, and that's one of the main reasons why we want to try and produce some content that is aimed at helping people understand some of these problems with the space, or some of the things that could happen.
This is the great time to educate people. You're absolutely right. But at the same time, yesterday I had a call with one crypto influencer who has a huge YouTube channel and Telegram channel, and he was complaining that he sees a lot of people unsubscribing daily once the bear market started, because they are losing interest, and instead of educating themselves, they are unsubscribing because they can't earn right here, right now.
There's always going to be that demographic of people in any gold rush. And those people, in my opinion, were likely led into this space by not this influencer in particular, but maybe other influencers that are tarnishing the name of cryptocurrency. And as soon as you hear the phrase 100x, and then you understand that you could turn $1 into $100, of course it'll gain your attention. And maybe this space attracts a lot of people with fast cash, and they're looking for quick gamble, and then they lose money. And of course, those people will leave if they're not passionate about the technology, or they're not passionate about maybe backing a team or a startup or a company they really like that sounds good to them. It's the same reason why I buy a stock sometimes. Like I think that this could turn into something very big and be very useful. There's always going to be a demographic of people that are in it for the gain, and that's it. And those are the people that are in quick and out quick. So yeah, I think there's no getting around that. But it's funny because it's the same type of people that I think they fueled the initial craze for play to earn in this space. And it's a very dangerous game that play to earn is playing right now, pun intended. Because you see a very strange misalignment in messages on pitch decks and white papers on new play to earn games coming to market, where they're talking about real world entertainment value in their game, but they're actively targeting their marketing towards GameFi enthusiasts that may be coming from Axie Infinity that are only looking for a play to earn ecosystem. It doesn't matter what they do or how much time they spend doing it. They're looking for a gain. And these are the same people that will leave your play to earn ecosystem as soon as your emissions start being controlled in the sake of longevity for your play to earn game. So it's the same demographic of people that I think need to slowly be educated and turn into a demographic of investors or enthusiasts that really understand what they're buying.
Actually, this is another topic I wanted to discuss with you. Some months ago, we made a video with on Yavin from Cointelligence, where he thinks play to earn model is over. And for the next period of gamify sector development, we will see play and earn substituting play to earn. I think it is very wise idea. And in your recent article that play to earn model is a waste of human resources in Medium, guys, the link is in the description. So you also mentioned the same idea that play to earn is unhealthy for the sector. I like your example about Axie Infinity. To be honest, when I first time tried to research about Axie Infinity and download it in the Google Play, I spent half of my weekend trying to understand what is it and how can I just download and start playing. And finally, I failed. I could not do it. And yeah, maybe I am not a gamer and not the smartest guy in the room, but I think it has nothing to do with mass adoption, and it has nothing to do with real attraction of gamers, of players to the gameplay. So my question is, you say that the next iteration will be play and earn, where attractive gameplay, interesting, great quality of games will attract at the first place. Gamers will be incentivized to spend money because of them enjoying the game, right?
Well, in that article, I go into some very critical points, and I don't think there's anyone as critical as me when it comes to play to earn. The main point is that we're not seeing anything new. There's no innovation happening, and by that I mean nothing is being invented. This already exists. So if you talk about play to earn and play and earn, some people have some definitions that are like very clearly designated, but in my mind, it's a spectrum, and the spectrum is dictated by the actual quality and entertainment value of the game. Every video game has some sort of value, right? And every video game has some sort of corresponding shelf life. And no matter what people say, I've heard a lot of conversations on YouTube and LinkedIn about play to earn and play and earn, and people talk about how to make a play to earn game sustainable. Well, in this article, I say you can't. It's impossible, right? And if you talk about a sustainable game, in my mind, it's like Diablo 2 or StarCraft that people play for 30 years, right? That's the most sustainable because the entertainment value continues to be there. But every game has a shelf life, essentially. Call of Duty is like a 4-year shelf life, and that's why they release a new game every 2 years or so. So it's more about aligning whatever token economy that you want to develop with your proposed shelf life of your game. And that could evolve depending on how much you reinvest and how much you develop that game and try and create new and engaging aspects to your game. But there is a shelf life and there's a limitation. And you have to understand first and foremost what you're building and who you want to target with it. So play to earn in my mind was like a job. You play a game. Let's say Axie Infinity wasn't a very fun game, right? But you're playing it and you earn some money. And taking aside all the success of Axie Infinity, you're really just talking about creating a mundane job that maybe doesn't bring any real tangible value to the world. Play and earn already exists. You have very popular games out there like Fortnite, League of Legends, World of Warcraft, PUBG, etc. All of these games are very engaging. They're very fun. You can sit and play them for 2, 3+ years, and they all include some sort of in-game economy. So the real benefit of Web3 and blockchain that GameFi projects should be communicating is that, hey, take this already existing thing and then just open it up so that whatever you create in this game, or maybe let's say whatever you win through a battle or whatever rewards you earn, there's a fiat off ramp. And if you choose to exit this ecosystem and maybe make a little money, that's fine. But in this article, I quoted, or not quoted, but I said the end product should be your game and the ecosystem should be your feature. It should not be the other way around, which is, in my mind, what Axie did and what all of these news articles picked up on, right? The entertainment value, how good your game is first and foremost. Because at the core, if you're talking about a play to earn or a play and earn system, it's broken. The system fails faster with user acquisition, which is why emissions need to be controlled. And if you're targeting this traditional GameFi Axie Infinity demographic and saying, hey, we've got a really cool play to earn game, it's actually fun and you can earn, and they come on board, the likelihood of these individuals just wanting to earn more than actually playing is pretty high. So as soon as your emissions is controlled enough where you're thinking about how do I make my game last 1 year longer? How do I align it with the entertainment value? A lot of these people will leave. So it's an emissions-based system. And if you're talking about a business model, that's one of the absolute worst. You're talking about fundraising, developing something, and then just giving away money. So if you don't have any real revenue generating structure in the system, then you're not technically a business, you're a charity. So what you should be doing is thinking, how do I develop my revenue streams in a GameFi project? What am I selling? And what's the value behind it? And if you take a look at Fortnite, for example, they sell skins for their firearms and for their characters. They sell different types of items. These are all things that make gameplay a little bit more interesting, right? And that's a tangible revenue stream, but you have to understand there's risks involved. If your game's not fun or exciting enough, it's not exciting enough, and you don't take that capital and reinvest it back into the game and develop something more fun and exciting, it will not sustain as long. So play to earn is a very, very delicate balance right now. Play and earn is just same thing on a different spectrum, where I think people are referring to an actual AAA Call of Duty tier game where the token economy is just a little bit less prioritized.
Can you please elaborate what do you understand under AAA game?
For a AAA game, so this is interesting because I had recently read a white paper for a GameFi project that has a mobile game. It's like a 2D sort of like battle mobile game, and it looks very fun, but they refer to themselves as AAA. I'm talking about there's really it's a subjective line, and there's no clear definition in my mind. But if you're talking about a AAA game, I'm assuming that you're going to need at least $10 million in development funds. This is something that's going to be taking place over the span of 2 to 3 years. You're talking about a big blockbuster game, a real big production that you are investing a lot into, and you're not doing it because you want to make a token economy, make money from. You're doing it because you love it, because that's the essence of game development, really. People create these games because they love gaming. And what we've seen in the early GameFi craze is people creating games that were very easy to develop, that had some sort of token economy that they could give rewards away with, that really couldn't keep anyone glued to the screen more than 15 minutes. So that's the real distinction I'm going after.
Awesome. Thanks for clarifying it. I think it's very important to clarify the terminology because everyone understands different under AAA meaning. And I see a lot of startups who are fundraising, just calling themselves AAA without having any base. I promised you 1 hour interview and running already over the time. So first of all, I want to inspire the people for watching us right now. If you feel it's interesting, please leave your comments and questions for Sasha that we could not cover today during the interview. And we will definitely make a part 2 if we have enough interest and if we see that you ask smart and interesting questions. And Sasha, before we finish today, I have so many more questions to ask you about. Maybe one just to summarize and to give some advice for founders. One of your main expertise is token economy, tokenomics. And you see so many different projects in this area. What founders should avoid doing when they are building tokenomics on the early stage of their economy development and business development?
This is an interesting. Well, first of all, thank you so much for having me on, Nelly. And yeah, I love answering these questions and going back and forth with you. I'd love to continue this another time as well. So I appreciate the time. For founders and tokenomics, I think the greatest but most difficult to accept piece of advice I can give is understand what you want from your investors. And by this, I mean create vesting schedules that you are comfortable with, knowing the value of your product and your long-term vision in that product development. Understand what vesting schedules you are comfortable with, because you may onboard investors that will consider the vesting schedule as a prescribed dump, and they are not afraid to take gains. And if you have trouble finding investors that are willing to accept those vesting terms, you're looking for the wrong investors if you believe in your product.
So you mean that there should not be exceptions when you define vesting schedules that are good for your business. You should not really change it when you hear feedback from VCs that, come on, I could invest, but if you shorten it 3 times or whatever else, right?
Absolutely. Those conversations happen every day, and they especially happen with launch pads, where they understand what their community wants out of an IDO and what they're willing to pay for. You should understand, if you're going that route, you are selling your own equity to a very, very specific demographic of investors. So you might be going after the wrong investors. If you really believe in the value of your product, if you know that your roadmap is going to take 3 years to complete, and you're going to have some real tangible revenue or value coming in, and you want a 4-year vesting schedule, stick to it. Because if your investor documents and your message is aligned and well developed enough, you'll find the right investors that'll believe in you. I do not waver if someone is telling you to shorten your vesting schedule by 50%, because there might be something behind the curtain that they want out of it, and it might not be the best for your business.
Great advice, Sasha. Thank you so much. And I believe that investors like you, they really need more visibility, more recognition. I'm great to see that you are now with your both feet on this ground, building Arcanum Ventures. I hope to see it developing further and becoming bigger and bigger and bigger VC, but keeping the same values as you have right now, and not turning to arrogant top tier VC in a couple of years. Who is
I hope not. Thank you so much.
Thanks a lot for your time, Sasha, and good luck with your investment portfolio. And guys, I will leave the contact details and links in the description of this interview. You can reach out to Sasha, pitch your project, and if not get invested, get very, very relevant, valuable feedback. Thank you for watching us.
Much appreciated, Nelly. It was great speaking with you.